This is the financial brief. Inflation has now stayed above the Fed's 2% target for more than 5 years, and the central bank just admitted it still can't bring it down. Most people saw the latest inflation reading and shrugged. 3.8% in April. Not great, not terrible. But here's what they missed. Minneapolis Fed President Kashkari just said something that should make every borrower in America pay attention. He called inflation simply much too high and warned that if price expectations become unanchored, the Fed would have to respond, in his words, even more aggressively. That's not a talking point, that's a threat. Here's the concept traders are calling the anchoring trap. The Fed's kept rates elevated for so long that markets have started treating high inflation as normal. Kashkari is pushing back hard against that complacency. He acknowledged the labour market is in decent shape, which means there's no employment crisis forcing the Fed's hand toward cuts. And that's the problem for anyone waiting for relief. If jobs hold up, the Fed has zero incentive to ease. Your mortgage rate stays high. Your car loan stays expensive. Credit card debt keeps compounding. Now, you're probably wondering, when does this actually end? Kashkari didn't give a timeline. He gave a condition. Inflation expectations must stay anchored. If they don't, expect rate hikes, not cuts. And that changes the entire playbook for the second half of this year. But the inflation story isn't just about the Fed anymore. It's about what's happening in the Middle East. Turning to energy markets, oil just swung significantly in a single session, and the reason is a conflict that won't stop escalating. Note, unverified. Fresh US strikes hit an Iranian military site believed to threaten both American troops and commercial shipping through the Strait of Hormuz. Brent crude moved higher to $96 a barrel. Note, unverified. West Texas Intermediate followed, also climbing. Note, unverified. Here's the thing. Earlier the same day, Secretary Rubio said Washington would give Iran talks every chance to succeed, and oil dropped on that headline. Then the strikes happened. Prices reversed violently. Traders are calling this the Hormuz whipsaw, and it's becoming a pattern. Diplomacy pushes oil down. Missiles push it back up. Nobody can hold a position overnight without getting burned. Think about it this way. Roughly 20% of the world's oil supply passes through that strait. Every escalation feeds directly into gasoline prices, shipping costs, and the broader inflation numbers Kashkari just warned about. Those second-round effects that analysts keep referencing aren't theoretical anymore. They're showing up in grocery bills and utility costs across every developed economy. And central banks globally are watching, recalibrating rate decisions around energy risk they can't control. So that's the geopolitical story. But while oil traders were sweating, one corner of the tech sector just had a blowout night. On the corporate side, Snowflake just posted one of the most dramatic single-day moves in enterprise software history. Note, unverified. Shares rocketed higher after the company crushed earnings expectations and announced a $6 billion commitment to Amazon Web Services over 5 years. Note, unverified. The adjusted earnings came in at 39 cents per share on $1.39 billion in revenue, blowing past estimates. Note, unverified. But the real story isn't the earnings beat, it's what's driving the acceleration. Snowflake's leaning heavily into Amazon's custom Graviton chips and cloud-based GPUs for artificial intelligence workloads. This is the AI infrastructure build-out in action, and it's separating winners from losers in real time. Now, here's the contrast that matters. On the same night, Zscaler, a cybersecurity company, tanked significantly for one of its worst days after issuing cautious guidance and announcing a sales leadership shakeup. Note, unverified. Salesforce also disappointed with light full-year guidance despite beating on the quarter. Note, unverified. 3 enterprise software companies. 3 completely different outcomes. The market isn't rewarding tech anymore. It's rewarding AI execution specifically. And the question every investor should be asking is simple. Which companies are actually deploying AI infrastructure and which ones are just talking about it? That gap is widening fast, and it's creating the starkest divide in tech valuations we've seen in years. The companies that can prove AI revenue growth are getting rewarded. Everyone else is getting punished. 3 signals today: inflation, energy risk, and the AI divide. Subscribe for tomorrow's brief. This has been the Financial Brief.